What's going on, everybody? It's Joe here. It's time to trade and get paid. I got one for you today that is going to be the start of a 3-part series. I'm going to give you 3 strategies that anybody can use to be profitable from day one. It doesn't matter if you've got $100, $1,000, or $1 million in your account. These strategies will help you to flip those accounts, build them up, compound them, and make some money. If you're ready to see this, hit that subscribe button, and I'll see you on the other side of this intro. Alright, so the first strategy I'm going to give you in this video is going to be a fair value gap strategy. This is basically where we find imbalances in the market, and I'm going to show you real quick what that means and then how to trade it. Let's take a look at these charts. A fair value gap is when there is an imbalance in the market. An imbalance simply means that there is too many buyers and not enough sellers, or too many sellers and not enough buyers. Essentially, we're just talking about supply and demand. But how do we find fair value gaps? Here's what we do. Number one, we have to identify a trend. So the first thing we're gonna do is we are gonna identify that we are moving in an uptrend. You can see here that we are moving upwards, and that is our current trend. Now, once we identify the trend, then we have to identify that we have clear market structure. So after this kind of news event here from this past week, which by the way was a crazy news event, after that news event, we kind of had this little base that started, and then after that, we started to get more into some actual structure here. So you can see we actually have some real structure in the market since the news event passed, all right? So let's start here, and we're looking at this little uptrend, this little piece right here on GBP USD. So you have your low, your high, your higher low, higher high, and so on and so forth. So how we're gonna do this is we're gonna identify in the market where we see gaps, okay? So, and I mean substantial gaps, not no little gap, all right? The first thing, what I mean by a gap is when we see, for an example, and I'll show you where it's at, this candle here stops right here. That's the high point. That's where the wick is. Then the next one is a big bullish candle in the direction of the trend. It has to be in the direction of the trend. Then the next candle here, when it pulls back, notice that on all of the other candles, most of them anyway, you have where price pulls back, goes up, pulls back, goes up, and each time it does that, it kind of gives you these, it pulls back to where the other previous time period ended and kind of closes out orders, all right? And so, and I'll explain more about that later. But what happens here is this next candle ends up pulling back only to here, creating a gap, okay? So now let me show you what that looks like in actual markups. Let's make this a little bit bigger on the screen so you can see it better, and we'll go from there. So we spread that out. Now that we're looking at this, we have our market structure here, and here's what we're gonna do. I like to use lines or a box, it doesn't matter to me. So we have our structure, we see we have a pullback here, and then a strong push up. So we see a big volume move. Now, volume is the key to trading any strategy, but particularly for this strategy, we must have volume in the market. You do not want to try to trade gaps in a dead market. So my recommendation, stay away from the Asian session, Sydney, right? You want to be trading fair value gaps depending on your pair during London or the US session. That's really when you're gonna have volume in the market, and that's really where you wanna see yourself getting into market trades. So stay away from dead sessions, all right? So we're gonna skip all this and we're gonna go to here where we see volume come in the market. And when we do, I want you to notice, look at where that wick stops right here, okay, on that little yellow candle. We have a big volume candle and it starts to pull back. But notice that this next candle after the volume candle does not come all the way back down and fill that order. It does not come back and fill out where the previous order was. So you have all of this bullish volume in the market and nothing to balance it out. That is called an imbalance. When you have too much of volume of one kind, too much bullish volume in this case that is not regulated, it's not balanced, it's not filled, the orders are just left out there and it doesn't get filled, that creates an imbalance or what we call a hidden gap or a fair value gap. So what we want to do is we want to have a line on the top of that wick and the bottom of the next wick. Therefore, this candle, this body right here, is an imbalance. Now, watch this. How do we trade an imbalance? What we want to do is we want to see that we have a true definitive direction. Now, let me give you another little tip here. It doesn't matter what strategy you're trading, whether it be an indicator strategy, a price action strategy, a supply and demand strategy like this. Anything that we do, we have to have entry candles. We can't just get into trades arbitrarily. You can't just get into a trade simply because of a zone or a market structure. We need entry candles, pin bars, engulfing candles, hammer candles. We need entry candles, shooting stars, morning stars. We need things that are gonna help us get in the market and tell us that there is an actual entry point, not just something that comes back into a zone, okay? So many traders would have lost right here, and here's what happens. Price comes back in. Ultimately, we still have this imbalance that needs to be filled. And so what happens is price comes back down into this area, this zone, and then it comes back out. So we have it come back in, and then we have a close outside, and many people would consider that a breakout. Now the problem is this black candle is not an entry candle. That black candle in and of itself does not give us entry. It actually is telling us that there's a possibility for more bearish movement because you see that the wick on the top side is bigger than the body on the downside. So we would not want to get into a buy position here because it does not give us, even though it does break out of the imbalance zone, it does not give us an entry candle. The next thing that happens is price pushes down again, and look, it comes all the way back down into that area in the bottom, very close, within just a couple of pips of that bottom of that zone, and it gives us an entry candle. So this is beautiful. We see price pull all the way back down, and then the bulls take over, pull us out. When we see that this is crossing past this area right here, we can enter the market. Okay, and so that's what we're gonna do. We're gonna take this, we're gonna enter the market right here, we're gonna enter right here, and we're gonna put our stop loss at the back of our imbalance. Then we're gonna take our take profit, and we are gonna just simply look left. And now when you look left in this particular trade, you can see that there is structure. Just look, there's a dotted line right there. You can see that there is structure right here. Now I'm not gonna tell you to go all the way up. I would tell you to go and get a good risk to reward. Maybe 1 to 2 minimum, or maybe 1 to 3. In this particular case, you're at about 1 to 2.8 in your risk to reward, which is beautiful trade setup. So here's what happens. The market enters, you see that price pushes up, you start getting into profit, you get a little bit of a pullback here, and then price just continues on up, and you get an 86 pip winner. 86 pips on a 15-minute GBP USD chart, and beautiful risk to reward, easy setup, and all we did was wait for price to come back and test the imbalance. If you will do this consistently over and over again, just do this, that's it, you will be able to grow your account consistently. These fair value gaps and these imbalances are consistently and highly profitable. Anytime that one is created, we typically see the market come back to it and we can trade away from it. Now, we want to make sure that we're not just taking trades arbitrarily, as I said earlier. We want to make sure that we are looking and finding entry candles. Make sure that you have a set of confirmations. Maybe you want to use a moving average that shows you that you're in the right direction. You find the confirmations that work for you, but for me, I like to find entry candles, pin bars, engulfing candles, close above, close below candles, and that's how I like to trade. So this strategy, just simply finding fair value gaps in the market, will help any beginner, intermediate, or advanced trader take their trading to the next level. You will make money, you will win trades by simply doing this. All right, guys, there you have it. I hope that brought you a lot of value. This is a really easy, very simple strategy. And I know that you can be profitable with the strategy because I do it all the time. This is a personal strategy of mine. I do it a lot. I use these gaps a lot. I teach it in TGP. We use them a lot, and they are highly profitable and highly predictable, okay? That's what we want. We don't want fancy. We want simple and predictable when it comes to the markets. So ask your questions, comment below, and let me know if there's something that maybe you don't understand. Let me help you, and I will help you take it to the next level. If you're interested in really taking full courses on this, go to my website, tradeandgetpaid.com. You can become a student today and I'll take you the rest of the way. I'll be able to hold your hand, walk you through our system, and you will be able to do great things in your trading because of the education at Trade and Get Paid. So go to tradeandgetpaid.com, become a student today, hit that like button, subscribe, and I'll see you in the next video.